Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Heung, Senior Investment Strategist with our CIO office, and welcome to this episode of Through the Noise. This week, I'm actually very happy to be joined by my colleague Fook Hien, also a Senior Investment Strategist within our CIO office. Welcome, Fook Hien. I think the weekly report this week clearly highlights the importance of the U.S. earnings seasons. But before we get into the details there, can you give us a bit of the market backdrop, why earnings are so important right now?
Yeah, hi. Thanks, Ray. The US Q3 earnings season, it comes at an opportune time. Investor positioning and valuations in US equities are stretched after global equities scale record highs. We also see the US dollar has bounced 3% after hitting a 3.5-year low in September, thanks to the continued government shutdown and renewed political and policy uncertainty in France and Japan. Meanwhile, the gold rally has accelerated in recent weeks, crossing $4,000 an ounce for the first time amid renewed concerns about fiat currencies due to increasing dominance of fiscal policy across developed markets. So we expect US earnings to beat expectations again on the back of the AI-driven investment wave, and this will be sustaining the equity rally over the next 6 to 12 months. Nevertheless, this global setup, it warrants a diversified allocation across asset classes and regions with hedges. On gold, it is facing a near-term road bump due to one-sided bullish positioning, but it remains a key portfolio hedge.
Thank you, Fook Hien. Actually, you have a very good setting up the stage kind of description just now. So maybe let us just dig into the details on the U.S. earning right now. What are we expecting from the third quarter earnings season?
Yeah, so we see the robust earnings growth. It should be driving US equities higher over the next 6 to 12 months, including our preferred sectors of technology, communication services, and healthcare. The major US banks, they will kick off the earnings season on the 14th of October. The US earnings growth is expected to decelerate from Q2, where we saw 13.8% year-on-year growth, and then Q3 now will have 8.8% growth, and then further deceleration in Q4 at 7.6%. And this is according to LSEG IB's estimates. So Q3 growth is likely to be led by technology and real estate sectors, while energy and utilities are the laggards. And the expected growth in 2025 earnings is at 10.8%, which is revised up from 8.5% at the middle of the year. 2026 earnings growth estimates have been stable since the middle of the year at 14%. Our three overweight sectors, communication services, technology, and healthcare, they are likely to lead a 2025 earnings growth. AI investments would be boosting the growth in technology, and the use of AI tools and strength in digital advertising and online entertainment, it will help the communication services sector. Now, regulatory uncertainties have been hurting the healthcare sector this year, but valuations are attractive now, and tariff uncertainty is easing. So heading into 2026, technology should continue to lead in earnings growth, along with the cyclical materials and industrials sectors.
I see. So we also have been hearing quite a bit of noise lately about the semiconductor export restriction to China. Do you expect curbs on the export of semiconductor equipment to China to be impacting the U.S. technology sector?
Yeah, I mean, further export restrictions would likely lead to volatility in the US technology sector, but the growth should remain intact, driven by AI investments in the US. We see that in recent days, a US House committee has called on the Trump administration to expand the export bans on the sale of semiconductor equipment to China. In addition, the Section 232 semiconductor tariffs remain under investigation. These factors add uncertainty on the sales to China, which account for 18% of the US semiconductor industry's revenue and 13% of the broader US technology sector's revenue. However, analysts are already conservative in their China sales estimates following companies' forward guidance. It already excluded the sale of the moderately advanced semiconductors to China. Meanwhile, there has been rapid growth in the AI infrastructure spending plans in the US, which boosts earnings estimates. So 2025 earnings growth in the technology sector has been revised up to 20.9% from 16.8% at the mid-year. And the growth forecast in 2026 also revised up to 21.9% from 18.7%. So further curbs to China may cause a headwind, but it's US AI investments really which underpin the bulk of this growth.
Thanks for that. Let's switch gears a little bit. So gold was piercing over 4,000 US dollar per ounce before retreating a bit. What's your view? Shall we be continue adding to gold at the current levels?
Yeah, our view is that gold is poised for a pullback in the near term, and investors should trim your excessive exposure. As you say, I guess gold has surged 3% so far in October and bringing year to date gains to over 50%. And prices are rapidly approaching our already upward revised 12-month price target of $4,100. Investor positioning has become stretched, while our investor diversity indicator has reached levels that historically signal a high probability of a pullback. We remain overweight on gold with a 7% allocation in our balanced foundation portfolio. However, given the rapid rise in prices, investors who are over allocated, either actively or passively, due to the strong returns, they may consider taking partial profits and rebalancing their portfolios. For investors who are under allocated, we would wait for a pullback towards 3,850 before gradually building positions as we continue to see positive long term structural drivers for gold, including a persistent central bank demand.
What about commodity currency then? I think particularly talking about the Aussie dollar.
Yeah, strong gold prices they bode well for the Aussie dollar, and a softer broad US dollar outlook and a relatively more hawkish RBA versus the Fed is supporting the Aussie dollar to the US dollar. And besides gold, iron ore remains Australia's largest export earner, and iron ore's rebound from the June lows has also helped stabilize the broader Australian economy. So higher commodity prices will improve the terms of trade, lending tailwind to the Aussie dollar to US dollar. So we believe that Aussie dollar AUD to USD, it may edge higher towards the resistance at 0.67.
Okay, thank you. Final stop on developed market government bond. I think in particular talking about the G3 government bonds have been experiencing yield curve steepening over the past week. Do you think what were the main driver and what is the near-term outlook for the G3 government bonds?
Yeah, our view is to add medium maturity US dollar bonds if the US 10-year government bond yield rises above 4.25%. And also the French bank bonds are interesting. We would buy add it on dips. The G3 government bond yields in the US, Europe, and Japan, it rose over the past week amid political changes in Japan and France. In Japan, Sanae Takaichi won the LDP leadership election, and she is pro-stimulus, and that may delay the Bank of Japan's rate hikes. There are concerns that this may lead to increased Japanese government bond issuance to cover deficits. Now, in France, Prime Minister Le Cornu resigned after failing to form a cabinet and secure budget agreements in a fragmented National Assembly. And the shift in sentiment also impacted US government bonds, particularly in the month of October, which has historically been a weak performing month due to increased supply of long duration bonds. We expect the 10-year Japanese government bond yield to be capped at 1.7% in the near term, as the Bank of Japan may control the yield curve if there were to be excessive rise in yields, and if Takaichi implements less drastic fiscal policies than what markets are expecting. For France, we believe the yield premium for holding French government bonds over German bonds will remain elevated, although it is still below the level seen when Prime Minister Barnier resigned last December. While fiscal consolidation in France is necessary and the path to sustainability is challenging, we see this risk as localized and unlikely to trigger another European crisis. And then in the US, a recent labor market data indicates a gradual softening in demand, supporting further Fed cuts and limiting the scope of sustained yield increases. We expect the US 10-year government bond yield to trade within a 4 to 4.25% range. So we recommend adding long-dated US dollar bonds if the 10-year yield rises above 4.25%. And we continue to favor the 5 to 7-year maturity bucket, which offers a good balance between yields versus fiscal and inflation considerations. Investors can also consider adding French bank bonds on dips as we see potential for recovery amid these challenges.
Thank you, Fook Hien, for the insightful sharing. So, if I may, in summary, we expect another strong earnings season driven by the AI technology sector earnings bits. And one thing that we have been communicating to investors, though, is that with concentrated exposure in the US equity, investors shall consider rotating into other equity markets, especially in Asia as Japan. We also promulgate investors to take advantage of the increase in developed market government bond yield to lock in the still attractive yield. On the gold side, is still an overweight, but we will wait for a pullback towards about 3,850 US dollar per ounce before gradually building positions. That's all the time we have for this week, and thank you for listening. Please stay tuned to our next episode of Through the Noise. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.